All right. We are broadcasting for all attendees, and so far it's just us.
All right.
Oh, there we go. We got people entering the room, so that's good. So that's good. You guys will all get this. Good. I got to back way up to get the hat in, Jim. So way up to get the hat in. So,
That's
all right,
awesome.
cool. Everybody's coming in, so that's cool. Tony's got a little message out there for everybody, so that's great. I think we've got. We'll let everybody get into the room. It's a little early. Happy St. Patrick's Day, everybody. So I found this small hat to celebrate. So, and actually, I have an Irish teammate named Brian, who is an intern here, who is always wears green and has asked for the hat after our presentation today. I think he's going to go out tonight and probably drink some green beer with it. So
Looks like a good head for that.
I got to open up the chat. So good deal. All right. Tawana loves the hat. So Maria says hello. So I will not be wearing this the whole time. So it's a little warm. You got the green shirt on though, Jimmy. That's good.
Yeah, I do. You know what? I'm not painting the back wall until about 3 o'clock this afternoon. I'm painting it green, but I didn't have time for the meeting. So
Yeah, it's very blue. I like the cabin look of your office, so that's
yes,
good. For those of you who don't know, Jim is actually with Illinois Credit Service, and the one thing aside, like the name should tell you, he is your credit repair guy right here in our market. So, as a matter of fact, that log cabin building is in Plainfield, correct, Jim?
yes, it is.
There you go. So, in his office today in the log cabin house, you're on a main road too, aren't you? Like people would
Yeah,
know
we're
this.
yeah we're right off of route. We're on Route 30, right off of I-55. We've been here since 2009.
Okay. Yeah. Perfect. I think
Mhm.
we've been doing business with you for all of those years too. So that's good. All right. So we're at 12:01, and I like starting on time. We've got the room filling up. Everybody's hopefully that ordered has their Jimmy John sandwich like I do. So this is our virtual lunch and learn on St. Patrick's Day. Thank you guys for showing up. What we're going to do, we've got Jim Drusky here, which I'm really, not only is he a good friend, but he's just such a great resource for us because we're able to utilize his knowledge, his expertise, and get him helping our clients out. So we're really excited to have Jim here. Jim, we got a lot of new stuff to talk about. I know we've done some presentations in the past, but because of the CARES Act and things like that, there's some new things to talk about. Those of you who haven't joined us before, our format is pretty simple. Questions will be in the chat. As you guys enter the questions in the chat, maybe I'll leave the hat on the whole time. So I'm getting a lot of good compliments on that. So as we get questions in the chat, I'll interrupt Jim as he's going through the process. The more questions, the better. Then we know you guys are actually paying attention. And honestly, no question should is too dumb or whatever. Don't even think that because the question you have is probably on somebody else's mind. So, with that, we're going to turn it over to Jim. I know he's going to move the PowerPoint to take over the screen and make our images smaller. Maybe that's a relief with all of this green hat here. So,
Yeah,
Jim,
your head will never fit when I do that. So
that's true. So, I'll turn it over to you, Jim.
okay, perfect. So hey everybody, how are you? Thanks for joining us today. As Rich was saying, there's a lot of new things going on in the world of credit right now. Some things you may have heard of, some things you haven't. And so we're gonna there's a lot of basic stuff with credit that I'm gonna touch on some things that are really important to understand about scoring and things like that. But we're gonna touch on some of these things that are not necessarily changed yet, but are absolutely in the works that are going to be coming that are going to impact all of us that where credit affects our businesses. So, as Rich said, I am with Illinois Credit Services. I like to touch on for a second a little bit about me. There's a lot of so-called credit experts out there. I've been doing credit in credit related industries for over 31 years now. I teach classes at the College of DuPage on credit and credit scoring, do a lot of articles and news things with CNBC and Channel 2 and things like that. So the information you're going to get today is not just it's the right information. So like Rich said, ask away. When you got questions, I love questions. And so, type them in the chat box. So let's kind of dive in a little bit here. My thing is, when you're talking about in the real estate market, especially, the answer should never be no, that you can't sell somebody a house. There's a lot of people that are, they have the financial means, but their credit just isn't there. And you really want to change if to when. You don't want to tell somebody no. You want to, tell them when they can sell a house. So, or when you can sell them a house. So let's start talking real quick about the scores. This happens all the time. Your clients may go to a car dealership and that person may say that your score is a 542. You get a credit card statement that says your FICO score is a 618. You go to Experian 627, Credit Karma 644. Then Rich's office or his team will pull the credit and maybe they say it's a 561. The point is the scores are all over the place and it is a great source of confusion for people because they're like, what is my real score? I don't get this. Are they looking at different credit reports or what? And it's not the different credit report. The three credit bureaus supply the same exact information to every one of these sources. No matter who pulls it, they get the same information. The point is, there's different scoring models. And this is one of the things that I really want to focus on today, because it's a great source of confusion. And so I want to touch on why this happens. So first off, you don't have one credit score out there for each credit report. You literally have hundreds of credit scores out there grading your credit reports, literally. The credit scores, first and foremost, the credit score is not a grade of what you've done in the past. Everybody thinks that that's what it is. A credit score was always designed, since FICO scores were created in 1989, they were designed to help a lender figure out if they want to lend you money. And the way a lender looks at that is kind of one question and one answer. If I lend you money, are you going to pay me, right? So the credit scores are predicting future delinquency. What they're doing is they're not a grade of past performance. They're a prediction of what the consumer is going to do in the future. And so they're predicting, FICO scores are particularly predicting the likelihood that a consumer is going to go late on one of their obligations within the next 24 months. Okay, now it sort of starts making sense why there's different models, because there's a different likelihood of someone going late on their mortgage versus going late on their credit card payment or their car loan. So each industry hires FICO to create specific industry FICO scores predicting likelihood of a default for that industry. So I wanted to show you this. I'm not going to dive into this. I just wanted to show you, these are the FICO scoring versions currently used in lending. There are 28 different FICO models that for each different industry, for auto lending, for credit cards, mortgages, all these different versions. So this goes all the way through FICO 9. FICO 10's already been released. So now there's over 28. There's actually 56 different FICO models. If your credit report was run through each one of these models, you will have 28 different FICO scores. Okay, so I want you to pay attention real quick because I want to show you an example. All these algorithms are different. Like, people will focus on, hey, what's my FICO score? That's the one that matters. Every one of these can be significantly different. So I'm going to focus for a second on the auto lending score. If you notice, TransUnion has two different auto scores, an auto score 8 and an auto score 4. This is my daughter's credit report on one day in TransUnion, where the dealership ran her credit report through two different models, the FICO score 8 and the FICO score 4, because some lenders use one model and some lenders use another. So they'll run one report through both models just to see which is the higher score. Look at how significant the difference is between these two FICO scores. Same report, same day. It's 176 points difference. It can be huge. So all these different models have different dynamics to their algorithms. And so there's FICO scores, there's Vantage scores. So it's important to always understand which scoring model is being used. For the purposes of what we're talking about today, we're talking about mortgage lending. So that's primarily what we're going to focus on. But it's important that the mortgage scores are going to be changing at some point too. And we're going to touch on that a little bit later.
Yeah, and hey, Jimmy, I just want to point out too, because this is for agents. I think the big takeaway, at least in that first slide, is that, hey, Mr. Realtor, my Credit Karma says my credit score was 680, but you
Yeah.
sent me to your lender and your lender pulled my credit score and it's 580.
Yes.
Well, all of a sudden it's your fault as the realtor, it's the loan officer's fault. The bottom line is that little piece of education that we just shared, you guys can actually explain now to the consumer that Credit Karma and what a mortgage lender does, or what your car lender does and what a mortgage lender does, it's significantly different. And it kind of gets you off the hook, and it gives a little bit better of explanation to the consumer. So
Yeah, 100%. And that goes too for different mortgage lenders. Some people think, well, that mortgage lender might use a different scoring model than another mortgage lender. Across the country, it's a federal law written by FHFA. All mortgages must be underwritten with the three same credit scores. So you can't go to one lender, one mortgage company and say, oh, I don't like that score. Let me try this guy. It's the same scoring models regardless. They don't have a choice in that matter.
that's great. And
So
the FHFA is the Federal Housing and Finance Authority.
yes, correct.
Yep.
And we're going to touch on that in a little bit about these scores because that's a big change that's coming, but we'll cover that a little bit later. So this right here this is called the Fico Pie Chart, right? I'm not going to cover everything because if you've seen this presentation before, we go through the whole thing, but there are two aspects of it that are particularly relevant that you can use to help improve your client's credit right away, and some things that are just more important that I want to cover. The first biggest categories is delinquencies. That kind of goes without saying, right? I mean, if you have the presence of delinquencies, that's a big deal, right? It's 35% of your score. They look at how recently they've happened, how severe they were, and how many that has happened. So if you have recent late payments, that is absolutely more relevant than if you have a payment that was delinquent 30 days, 6 months ago. It's so much more meaningful on your scores in a bad way than a 30-day late that happened 4 years ago. So recency is important, and we're going to talk about how we approach potentially removing recent delinquencies under the CARES Act. So the other category that I wanted to talk about is debt ratios. This is the people who hear about this. It's not debt to income ratios, it's debt ratios. It's typically involves just your credit cards, balances of your credit cards in relation to the credit limits. There's a lot of misunderstandings or misconceptions about this. They calculate this two different ways. They calculate it card by card, and they calculate it as an aggregate, as a whole, all your cards together. If you have 5 cards, they're going to add up all 5 balances, all 5 limits, and they're going to do a calculation. The more important calculation is the aggregate total, not the individual card by card. So a lot of people will say, hey, don't have one card at 100% and the rest at 0. Split them up to 20% across the board. That is not the right answer. You're better off having one at a high limit. I mean, honestly, you don't want to have any of them at a high limit or a high percentage if you can avoid it. But you're better off not splitting it up, because if you have balances on too many cards, you can start losing points for having too many balances on too many credit cards. Starts to look like your credit card happy, like you using every piece of plastic you have, and that can be an adverse impact on your scores. Okay, so here's a quick example of how they'll calculate it. These are 4 cards, right? You have a $5,000 limit and 3 at $1,000, and then the balance is on the left. There's the calculations on the right, right? One of them's at 0, the other one's at 50, the other one's at 100, and then 110. You look at the bottom, the aggregate calculation of this turns out to be 32.5%. That's the important percentage for this person's credit in this example. Now, what do you tell your clients to do if their balance is high? And by the way, this applies, it's a percentage, it's not the dollar amount. This is where a lot of your clients that might be trying to build up their credit, they go out and get that $300 credit card, and then they buy a couple, some groceries, a couple tanks of gas, and all of a sudden they owe $250, and they pay the minimum payment and they pay it on time. That actually doing exactly that could actually drop their credit scores anywhere from 5 to 40 points, because it's not just about being on time. This calculation of how much you owe in relation to the credit limits accounts for 30% of your credit score. it's almost as much as going late on a credit card or going late on any obligation. So it's very important that if your clients have a higher percentage, that they bring that down immediately. You can see a score improvement. Now, what do you tell them to pay it down to? Everybody all over the internet, so many people that I know, credit, other companies, everybody, they all say, keep it down at 30%. Even FICO's blog says, keep it at about 29 to 30%. That is absolutely not the best answer. It is 30% is better than 50%, but 50% is better than 70. 70 is better than 100. The way to optimize your score is to keep it at about 5 to 10% of your credit limit. That's where you want to keep it at. Now, that might seem kind of meaningless. Like if somebody has a $300 credit card, you're telling them to keep their balance around 25 bucks or somewhere in that area. But this is an algorithm. This is a computer. This isn't a person looking at it. You are trying to tweak the algorithm to maximize credit scores. Now, I want to show you the impact of closing a credit card. In this example, let's say that $5,000 card that's a zero balance, let's say that somebody's not even using it. They're worried about somebody's going to steal their card, rack it up. They just don't even use it anymore. They just use the other three. I'm going to close that card. Now, what I'm going to show you has nothing to do with paying anything different, nothing to do with charging anymore. But if they close that card, whoops, what did I do? Here we go. If they close that card, you immediately lose the $5,000 off the aggregate. Your balance of $2,600 now goes to 26 divided by 3,000. You've changed 32% to 86% like that. And that will absolutely drop your credit scores. That is the primary reason that you don't close credit cards, because you're affecting your aggregate available balances or available limits. There's people will say that if you close your credit card, you lose all the history. That is absolutely not true. You don't lose any history. You stop gaining history, but this is really the primary reason why you don't tell anybody to close a credit card.
Hey Jim, we got a couple questions that came in, and I also wanted to make a quick point too. So regarding the credit reports that we pull, we use a company called Factual Data, pretty significant company. They pull all three credit reports in that we need to make a mortgage decision. So they'll pull in Equifax, Experian, and TransUnion, give us one master report. The one thing that we do on all of our credit reports, it's built in and it's an extra service we ask Factual Data to add for us, we pay for. It will tell us when we pull credit what the potential increase in score is. So if we've got somebody that's, let's say, a 570, it'll make a notation, hey, this client can get to 640. And then we click a button and it'll let us know what steps to take. I will tell you almost 100% of the time, it's this stuff. Paying down charge cards adds points quickly. So I wanted to make that point. It is a service I have and everything. So if we're talking to you about a client and we're mentioning to you that the client's not going to qualify today because of credit score, ask us, say, hey, what's their score potential improvement? Now, when I see that it's 576 and the score improvement is 581, it means that most likely the scores are low because of late payments and other things like that. So Jim will get into some things that he can do there. But Jim, I'm going to jump into a couple questions, but I wanted to cover that important point. So let's see here. All right. So this is a great question. So Ray asks, does it make sense asking for higher limits from your provider on cards to reduce the percentage, assuming you pay off the cards every month at the end of the month? So I think there's a couple things you can address there, paying off the cards. And of course, that doesn't necessarily mean that no balance shows up. But the first question, certainly, Jim, does it make sense to go to your existing credit card providers and ask for higher limits?
100% yes. It does.
Excellent.
There's two. It's a calculation of balance and limit. There's two ways. There's two factors there. You can pay down the balance. You can increase the limit. Increasing the limit. I mean, if you have $1,000 balance and you have $1,000 credit limit, you're at 100%. You have the same balance and you increase your limit to 10,000. You're at 10% without doing anything different. So absolutely. I mean, I I have a card that has 20,000, 30,000. I don't ever use that, but that's the game. It helps, higher limits help keep your balances down or your percentage down. So absolutely, it's a good idea. The problem is that they don't want to give you a credit limit increase when you need a credit limit increase. So if you call them up and say, hey, I'm at 100%, can you increase my, my limit? It's very tough to do that. The answer may be no, because they, when your balance is nice and low, your percentage is low, they want to give it to you when you're a good risk. So absolutely ask for that increase when it's the right time.
Yeah.
As far as paying off the balances, real quick trick on this is the credit bureaus only get an update once a month from credit cards. When you pay a payment, they don't get an update that payment was paid. They get information from the credit card companies once a month, and it tends to correspond with the closing statement date for each individual credit card. So it's not always the 1st, it's not the 15th, it's not the 30th. Look at your credit card statement and don't look at the due date. Look at the closing statement date, because the day that they send you your bill and say, hey, you owe $486, and then you write a check for the whole thing, when they send that bill to you for 486, that's the information they sent to the credit bureau. So it will say 486 until the next monthly cycle comes around. So if you're worried or concerned about what they're going to see, like if maybe a high balance and you're going to pay it off before the closing statement date, so that when they get the information delivered to the credit bureau, they're getting a nice low balance. It's just a game. When you pay it off is important.
Yeah. That's great advice though, Jim. I mean, you could actually just adjust how you're paying into your credit so that it's seeing the zero balance. So I've got another question from John. This one I'm going to read verbatim. It's to improve your FICO score on an American Express card, and you always pay your credit balance on time every month, would it be better to maintain a low credit limit?
No, well, first off, never having a low credit limit, you just don't want to have that. But here's the thing with American Express. They tend to not, they have a thing called a shadow limit, where you don't know that a lot of them don't have a limit. They kind of have a behind the scenes limit that they don't ever really tell you what it is. And so in lieu of having a credit limit reported to the credit bureaus, the credit bureau scoring algorithms for FICO will use the highest credit, the highest balance you've ever had that card at. That will become your limit. So that's when in the old days, a lot of credit card companies never reported their credit limits to any of the credit bureaus, because it was very competitive. They all look at each other's what they're doing, because they all run a maintenance report every month, and they look and see, well, Capital One's giving that guy $5,000, let's give him $6,000. So they use our card. So they started withholding the limits from the credit reporting, and in lieu of the limit, the credit bureaus would use the highest balance you've ever carried. So, but now that all changed. The government they passed a law that said you had to report the credit limits. So that's all changed. But on American Express, they don't really have a limit on some of those cards. So in that case, if you rack it up really high, one month, and you charge, $12,000 in 1 month and pay it all off, that highest balance you've ever had that card at will then be used as a calculation of your debt ratios for that card.
That's a great tip. So this is a great question from Scott. He asks, are there any advantages to getting a secured credit card if your score is low? And I know the answer to that one, Jim.
Yeah, secured cards are not fun. They're not, they're necessary. If you can't get an unsecured card, then that's the next step. They're high fees, and they're high risk, because, you may have had situations where you just couldn't get anything else.
Hey, Jim, do you want to, I didn't mean to cut you off, partner. Do you want to just describe, because some people might not even know what a secured credit card is. So
yeah, sorry. So unsecured cards are basically what we know is you apply, you get a card, you get a limit, you get to use it. A secured card basically is, you may have some things in your past where you're a higher risk, where they don't want to give you anything until you kind of create some security on that card, because all other cards are unsecured. Secured card means you have to give them $300, $200, $500, whatever you choose. You give them money, and then they're going to give you a credit limit. So you're sort of borrowing your own money. But sometimes if people have had difficult things happen in the past, that's where they have to start. If somebody doesn't have a credit card at all, they have to get, if they have to start a secured card, they just should have to do that, because you're never really going to have strong credit scores until you start establishing credit card activity, even if it's a secured card. And secured cards and unsecured cards have no variance in how they're treated at the scoring models. A credit card's a credit card. Now, they're high fees, they're high percentages, interest rates. Honestly, I tell people, don't even worry about the interest rate. If it's, I know this sounds bad to say, but if it's 29% or whatever it is, you shouldn't be using that card any more than 10% anyway. So if you have a $300 secured card, if you're charging a 1 tank of gas at $25 a month, don't worry so much about the percentage that you're getting charged. The important part is make sure you're using it as a proper tool to build your credit the right way, as a stepping stone to get into the better credit cards, the unsecured cards, and build your credit limits. And eventually, I always tell people, don't close credit cards. That's the one situation that you are going to want to close a credit card, because you want your money back, but don't do it prematurely until you've used it to properly establish other credit.
And Jim, is there a place to go for those secured credit cards if we're trying to counsel people on getting that start?
Yeah, actually, I can send a link, or I can send it to you, of the place that we have a list of them that we send all of our clients for, for them establishing different types of credit, including secured cards. I can forward it to you. You can forward it to,
Yeah, send it to us, and I'll make sure Tony gets it out to the attendees. So that's a great question, Scott. Yeah, so Kim had a question. I'm trying to get a little bit better clarification on that. So when I do, I'll get that. I'll let you keep going on the program, Jim.
Okay. Okay, so I want to talk about, there's a few things that are changes and trends in credit right now. The CARES Act and credit repair, which for a lot of people, the CARES Act is the COVID, crisis, the pandemic. What did it have to do with credit repair? So I'm going to talk about that. I want to talk about the new scoring models for mortgages, because that's a big game changer that's coming, and how they're treating collections now, and a thing called trended data. So let's kind of take each one of these. The CARES Act. CARES Act was passed by Trump in March, right? 2020. It's a 335-page law that was written in about 2 weeks, I think. I mean, that's unprecedented for Congress to pass something that quickly, but they needed to, and they did. But there's a section in there, section 4021, called the credit protection during COVID. This is where everybody was hearing that, hey, if you have a forbearance or if you skip a payment, it shouldn't affect your credit scores. Well, or it shouldn't be reported delinquent. And there's some conditions to that. But when I went back and I was reading that, because that's what I do, I read credit laws, right? So there's some very specific conditions about the CARES Act and credit that we are using right now to help correct recent late payments on people's credit, which, remember, we were talking about recent late payments, they're a killer on your credit score. But under this act, and again, everything with credit repair, there's no magic wand. It's based on laws. This is a law that's designed to protect consumers. So there's three things: impact by COVID, a thing called a covered period, and an accommodation. And then if those three things happen, it determines how the data furnisher must report information to the credit bureau. So let's talk about each one of those. The covered period, what does that mean? This only applies to any derogatory or any late payments that started January 31st, 2020 until the end of the pandemic, until it's over. It's still going on right now, right? Obviously, unfortunately, but here we are. So there's a lot of people that were impacted. They've had late payments, last year, whatever, it's happening. And so this only applies to payments that are derogatory in the covered period. Now, this is important. Definition of an accommodation. And by the way, you have to have been impacted by COVID in some way, which, who hasn't in some degree, income loss, job, anything that it could be. If the lender provides an accommodation, now this is where it says specifically, deferring one or more payments, making a partial payment, forbearance, any modifying a loan, or any other assistance. That wording right there can be anything that they do to help the consumer. They must provide an accommodation. We have people that are contacting us that they've had their late fee waived. Waiving a late fee is an accommodation. They have provided assistance. Again, the law is written a little vague, but it's specific. If they help you in any way, then you were impacted by COVID, then that falls under one of the conditions of how they have to report. Now, this is how they have to report. If you've been impacted by COVID, if you bring the account current after it was delinquent and they provided an accommodation, I'll just read the highlighted parts. If a furnisher makes an accommodation, the furnisher shall report the credit obligation or account as current, or if the consumer brings the credit obligation or account current during the period described in item AA, which happens to be, the covered period, they must report the credit obligation current. Now, this is a lot of information. This is all designed to protect consumers' credit during COVID. I challenge any consumer who knows this information. Nobody read the CARES Act, not this particular part anyway. And we have been using this to fight the fight for consumers that have an accommodation impacted by COVID, brought the account current. They had a couple we've had late payments on mortgages corrected to show on time, car loans, credit cards. And we're not saying it's 100% bulletproof, but this is not just an idea. This is a law that was created to protect consumers, and it's working really. We're finding it to work really well, and it just keeps coming because people are, the recent late payments are happening now. So
yeah, it's great. That's a great new tool for you guys to get stuff cleaned up in the last 12 months. That's good. Jim, I've got if you finish with this particular point, I do have a couple questions.
Yeah, go ahead.
Okay, so I'll start with the first one because I'm a little familiar with that, and then the second one I'm not so much. The question was about, what are your thoughts on rental karma programs? So rental karma, according to Kim, reports your rent up to 24 months back as a positive trade line. I know that doesn't impact score, but I'll let you kind of follow up on that.
Yeah, so here's the thing, and we're going to touch on different scoring models in another few minutes here down this presentation. But that's the thing, is that it's right now in the mortgage world, as Rich was just saying, it doesn't impact your score. It will show as a line item on your credit report, but it's really nothing more than what's referred to in the mortgage industry as a credit supplement. It shows on a report, but has no impact on your scores whatsoever. Now, there are other scoring models that it will impact. Remember all those scoring models I was showing you, FICO 9, FICO 10, Vantage score. They will count that rental history. But here's the thing, it doesn't count in the mortgage world right now because it doesn't impact those scoring models. Because those scoring models that the mortgage industry is using, they date back to 1999. Back then, rental reporting just didn't happen. So it will show on the credit report. They see it, but it's not calculated into the algorithm.
And Jim, one other follow up to that, and then I'm going to ask Kim's second question. We also see utilities show up as either reported by the utility or self-reported, and can confirm that has no impact on a FICO score as well.
Yeah, we're gonna that was in the next couple of slides, but let's just talk about it right here. Experian Boost, right? Experian is very aggressively marketing their Boost product, and to a consumer, I mean, again, it's limited information. They have everybody commenting on, oh, my score went up here. And consumers will sign up for Boost. They may see their score improve because they only take, what they do is you agree to give them access to your checking account data. Okay, not a great idea in my opinion, but you give them access to that, and then they search through everything in there, and they withdraw the utility data. They will only report positive data, not negative data, which is, the reason they're doing it is because data rules everything. These are data companies. imagine, forget the utility information. How much other information are they getting access to and having your checking account information? It's not a great trade-off in my opinion, because here's the thing. Newer models will count Experian Boost. Experian Boost also only reports to Experian, period. That's it. Doesn't impact the other two reports. But as Rich was pointing out, it does not calculate into any mortgage credit score whatsoever.
Nor does cell phone use. Scott asked about cell phone. Cell phone's going to fall in
Same
that
thing.
same category.
Same thing.
So now I will say this: there is still such a thing in the FHA world as what's called a manual underwrite.
Yeah.
In a manual underwrite, either A, we don't have enough credit established because maybe we have somebody that's not using credit, but they've got an apartment, they're paying utility bills, they're paying
Yeah.
cell phone bills. We can get a verification of rent and a minimum of two other things that are paid on time. That becomes what FHA classifies as a manual underwrite. We won't get an automated underwriting approval. However, with that on time payment, Scott, whether it's a cell phone or whether it's utilities and or rent, like Kim mentioned, with all those on time history, I can get those loans approved FHA. Last question for Kim that she had, and I think this kind of falls in that same bucket. I had never heard of this. Um, she asked what your opinion was of self-lender. Self-lender, I guess, is where you pay a small amount every month, and then at the end of either 6 or 12 or 18 months, you get a refund back, and then it reports that as a trade line. I've never even heard of that.
Yeah, it is a product that's used to build credit. And it, the problem with it, it's not a revolving account, it's an installment account. I believe anyway. But and you should have some sort of installment account. If somebody went through a hard time, they got nothing, they need an installment account, but they really want to focus on the revolving meaning credit cards. That's
Yep.
the more relevant aspect towards building credit. Because remember, credit scores are trying to figure the consumer out. They're trying to figure out if they're a good risk. On an installment loan, they kind of have one or two choices. They either pay it or they don't. That's it, right? And it is a good idea to have those kind of things, but you don't want your clients to overdo it. I mean, I'll see people they'll have like versions of self-reported, like small installment loans. They'll open up one, close it in 2 months, pay it off again, do it again, and they'll have like 6 or 7 of them. I'm like, what are you doing? And they're like, well, I'm building up my credit. I'm like, no, you're actually dropping your credit because they have too much opening and closing of activity. Credit card activity is far more important to start with. But again, at some point you do want to have an installment type loan too as well. Just don't overdo that. You only need one.
Okay. And so does that self-lender, does that end up reporting as an installment loan that
Um,
FICO would use?
yes, it
Oh,
does.
cool.
Here's the thing. Some of those companies, the credit bureaus kind of watch programs to make sure that they're actually legitimate lending programs. And some companies, I'm not going to comment on self-lender necessarily, but some of them lose their reporting rights because they know that they're not really legitimate lending programs. They're just trying to help people build credit. So I don't want to say self-lender isn't, but if it is an installment loan, yes, it will count. Just it will be calculated into the scores. It's not a utility. It's not a supplemental trade line like we were talking about. That's actually a legitimate, type of loan.
Nice. Well, that's great. That's great information that we got from Kim. I have one question, Juliet, and then after this, we'll let you get on to the next point. Is it a good idea to pay off your credit card each month or leave a small balance?
Um, it's well here. It's you want them to here. It comes down to a small percentage is better than 0% on your credit report. And this is one of the articles that I have with CNBC about having a perfect credit score is what I said 5 to 10% is the best percentage to have your utilization at. The actual optimal number is 1%. They want to see you using your credit, but not abusing your credit. That is a better, if it's zero and it's paid and you don't owe anything, then technically for all they know, you're not even using it. Now, zero is better than a high percentage. I'll tell you what I do is I charge up on mine. I have, I have pretty high limits and I'll charge up anything that I possibly can in a month to rack up some points. And my debt utilization ends up being somewhere between 1% and 3%. And I write the check right after the bill is paid. I don't try to beat it because I know that if it gets reported, it will be a nice low percentage. So I guess the answer is it depends on if that information gets reported, what percentage you're allowing the bureaus to see. You actually have the ability of how you manage this stuff to control what they see. So if it's going to be high, pay it down a little bit, but you don't have to pay it to zero. So it's a good point that don't pay it all off so it always reports zero. Pay it off where you're going to leave a small amount so you'll have a nice small percentage. 1-2% is certainly fine.
Perfect. Thanks, Jim.
Okay, so let's keep moving forward here. The Economic Growth, Regulatory Relief, and Consumer Protection Act. Okay, that's a big mouthful there. This is the one, this is also signed by Trump, 2018. It's coming up on 3 years ago. This had a lot of information in this bill, but the big takeaway that was kind of overlooked is that FHFA now was given the opportunity to consider other scoring models for mortgages. This is huge. This was also lobbied extremely heavily to get this law passed by the 3 credit bureaus. Because if you probably have heard of a thing called Vantage Score. Vantage Score is the scoring model that was created in 2006 by the 3 credit bureaus to compete with Fico. Fico and the 3 credit bureaus kind of coexist, but they kind of fight. They don't get along. They just have to get along. But FICO makes billions of dollars riding the coattails of the 3 credit bureaus. They create the algorithms and the bureaus do all the rest. Well, the bureaus decided, hey, we want a piece of the scoring industry. So they created a thing called Vantage Score. You go to Credit Karma, it's Vantage Score. You go to Credit Sesame, it's Vantage Score. Vantage Score sells almost as many credit scores as FICO does, but they're not used by the lenders. That's the problem. Primarily because FHFA by law has to use the same scoring models for all mortgages were underwritten. They're all since 1999, all the same models. This law said FHFA has to now consider other models. So there's a thing called an application process, validation and approval, and then replacement and implementation of new models. That's a process, right? And now we're all going on almost 3 years now, and we still haven't seen changes. This is going to be one of those things that it's coming. It's just a matter of how soon it'll be here. Basically, the section of this law was this credit score competition act or paragraph. It involved the replacement of a credit score model if the corporation, meaning FHFA, if they have validated and approved one or more credit score models, meaning they have to test the models and make sure they're actually valid, they work, and it's a good replacement, and they determine that the credit score model or credit score models that were previously validated, meaning the old FICO models, they shall no longer be considered validated and approved for the purposes of subparagraph B. Basically, what it means is that as soon as they say, we're going to use a new model, the old mortgage models are gone. They're going to the switch is going to get turned off, and they're going to use the new scoring algorithms. Now, it's not just Vantage Score. FICO also has put multiple hats in the rings. They put their FICO 8 model in the ring. They put their FICO 9 model, probably their FICO 10 model in the ring. And a lot of ways the government doesn't want Vantage Score to be the scoring model for the mortgage industry because it's too much control by the credit bureaus. Now they would control the credit reports and the credit scores. They'd rather have FICO. So it's more than likely, my guess would be that it might be one of the newer versions of the FICO models. And there's a lot of good things that are happening and changes in those models. So I wanted to cover a little bit of that. Ta-da, the big reveal. Okay, this is, without getting into this too much, this is just one of the reasons why you end up with different scores. The FICO algorithm has percentages, that equal 100%, right? How they calculate their scores. And this is a very simplified, oversimplified version of how they calculate it. you look at VantageScore, if they take the same exact reports, you're absolutely, this is why you have different scores, because their calculations are done differently. Okay, so keep an eye, if you haven't, start paying attention to VantageScore. They're very relevant. They're not going away. They're going to be used more and more and more. So this is also why when your customer says, hey, my score is this on Credit Karma, and it's not on a mortgage, it's in large part because of this. I wanted to bring up some of the differences of one of the models called FICO 9. And they started out with FICO 2, 4, 5. They skipped 6 and 7, went right to 8, 9, and now they're on 10. And it kind of think of these models like generations of operation systems for computers, like Windows Vista, Windows XP, Windows 7, 8, 10. Every time they come up with something new, the old stuff is kind of obsolete. It's, the newest, latest, greatest versions only work on the newest, latest, greatest, equipment. Well, the mortgage industry, by default, no decision of their own, they'd rather change it, but they've been using the flip phone of credit scoring models for years, but now they have the opportunity to change it. So let's talk about the differences of FICO 9, just some things in case they happen to use it. This is a big one. Paid collections, there's no score impact at all. If it's a zero balance on your credit report, it's no score impact. Now, do not leave at the end of this and tell your people to pay off their collections, because if you look at the very top, this is not true for the current scoring models used in mortgages. It works kind of the opposite. If consumers pay collections off on their credit reports right now, it could actually drop their mortgage scores. Again, they're treating them very different. I tell everybody, I say, don't tell them really to do anything until you talk to Rich or me or something, so we can guide you in the right direction. But you can watch the news and they'll say, hey, FICO just says, hey, pay collections, no score impact. And people are doing these actions thinking they're helping their credit and wondering like, okay, why am I getting further away instead of closer? Medical collections, they're going to be devalued right out of the gate, whether you pay them or not. Again, that's something that is not relevant in the current models for mortgages, because they're a medical collection. And in some instances, I don't know if you want to comment on this, Rich, but medical collections are treated a little differently by underwriters, but not by the scoring models. A medical collection is the same thing as a big screen TV you didn't pay for scoring purposes, but not necessarily for underwriting purposes. Did you want to comment on that at all, Rich?
Yeah, no, it's FHA's given us a little bit more when they start calculating collections that we need to address. They throw out the medical ones. They said, hey, you need to address the bad cell phone bill payments, the charge card that got charged off, and apparently that's the big screen TV you're referring to. But
Yeah.
that's they want us to address those collections, but medical kind of gets excluded from that in FHA's world. So no, that's a good thing. And then that paid collection thing is really important, guys. If you hear somebody, a consumer, saying, hey, I'll get back to you in about 30 days because I'm working on fixing my own credit, a couple hairs on your neck should stand up, in the sense that, what are they doing to work on their own credit? If they've heard, hey, make sure all your collections are paid. We've seen scenarios where people have paid those collections and they've dropped their scores. And ultimately, the reason those scores drop is, Jim?
Well, it's because the FICO algorithms are trying to predict future delinquency, right? So when they pull your credit today and they're analyzing all this information and making a prediction of what you're going to do in the next 2 years, remember, delinquencies that happen here are much different than delinquencies that happened a long time ago. So on the scoring models and for credit reporting, if you have a collection that has not been active for 4 years and you make a payment on it and it's a zero balance and you're waiting for that feel good feeling of that zero balance collection to improve your credit, the scoring models are going to treat that as if it's a brand new collection, because the date of last activity has changed from 4 years ago to the day you made that payment. And that's part of the problem why an outdated algorithm isn't really effective in today's times, and why it can hurt people, because they're on the news and they're announcing all these great things of paying collections helps you, but the most important purchase that you're going to make it can actually have a adverse impact on it. And so, yeah, absolutely, you got to be very, very careful. Again, all the more reason why you talk to a professional before having any of your clients take these actions.
Perfect.
Okay, trended data. I've been talking about this for a while. Something to pay attention to that it's right now it's not considered on most of the models, except if you do use a model called Fico 10T, which anytime they have generations of score, that means things are going to change at some point. They're just not here yet. What trended data is it's not just right now your credit report is scored as a moment in time. They'll look at all your balances, like let's say you have a $4,000 balance on a credit card that has a $5,000 limit. That's a snapshot, right, of a moment in time, and you make your payment, it shows on time, and that at that moment that will calculate 80% of your debt utilization, right? Well, there's some people that are paying off their minimum payment and then incurring interest, paying the minimum pay. They're just kind of floating right there, right? They're just keeping their heads above water. There's other people that they're using that in a different way. They might be charging up their monthly expenses, paying it all the way off, charging it up, paying it all the way off. Clearly, those are two different people and two different levels of risk. One is called a transactor, and the other one's called a revolver. Some are revolving their debts, they're never getting it paid off. The other one is just utilizing it in a healthy way. That's called trended data. It's how much you're paying over the required minimum. Now, in most of the scoring models, it's not calculated, but it absolutely, the data is being calculated, or it's being collected. It's been collected for years, and now they're going to start developing the scoring models to take that into consideration. So it's one of these things, like in most things in credit scoring, it's a double-edged sword, right? It's going to hurt some people, but it's absolutely going to help other people. So
Hey, Jim, I want to tell you, so we're starting to see, that showed up in our credit reports probably about a year ago, maybe 2 years ago.
yep,
We're seeing the information now. Why is that important? Because as Jim says, it's really not coming into the credit score. But we've had some
not yet.
right. But
Right.
we've had some transactions that we're super super on the fence, an underwriters, in spite of what people think, they always look for reasons to try to make a loan. And if we have something where we're concerned about the financial management of this particular borrower, and it might be, yes, there's late payments, or we get into bank statements, and people don't think about this aspect of it, but we'll get into bank statements and we'll see NSFs all over the place. So that's an indicator that this borrower is struggling to manage their financial well worthiness, or however, whatever you want to call it. But the other thing that they'll do, so if they're looking at somebody and an underwriter is really reaching to try to say, hey, what could I do so that if a supervisor ever comes to me or somebody says, hey, why did you make this loan that was in this gray area? We had some credit issues, we had some NSFs. She could potentially go to the trended credit data, which basically shows how much you pay on that credit card every month. If she could say, hey, look, we know there was some struggles here, but if you could look at the credit cards, she's paid this stuff off at the end of every month. She's not carrying a lot of balances. That's a lot different than seeing a 24-month history of somebody with a $2,000 Visa bill, and you look over the last 24 months and there's the $25 payment, there's a $25 payment, there's a $25 payment, and there's never been an attempt to reduce that balance. I've seen an underwriter basically say, hey, you know what? I'm even looking at this information and I can't find a reason to sign off and approve this loan because, again, the trended data states that they're a revolver, as Jimmy put it, and that's a challenge. So that stuff is, I mean, it definitely factors in. Hey, Jim, we're kind of getting towards the tail end of an hour. So I want to
Yep.
make sure that if there's any big meaty stuff in here, we point that out. We've
Yeah.
got something that Jim and I want to talk about too. That'll be something where you can use this information and our resources about credit to potentially market to your own clients. And I want a little time to talk about that too. So go ahead, Jim.
Yeah, for sure. Here, just cover this real quick and we'll get to that last part you were talking about. Um, A lot of people are not aware judgments and tax liens no longer report on credit bureaus as of July of 2017. They will show up on a mortgage report because mortgage reports technically are not tri-merges anymore. They're kind of quad merges, really, because they typically always get the information from TransUnion, Experian, and Equifax. But now they can't ignore judgments and tax lien information, so they get it from a fourth source called LexisNexis. So you will see, your consumer might not see it on their own credit reports that they pull because it's not on the 3 credit bureaus, but it absolutely will show up or can show up on the mortgage report. So the good part is it doesn't impact the actual credit scores, but it's something that you don't want to just ignore. Medical debts, they're no longer reported for 180 days. That's a law now. And just because the aggressive debt collectors would just slap it on there in 30 days, but now they give insurance time to work it out. And credit invisibles, that's Experian, but they're just trying to look for new ways to score more people so they can lend more money. And that's kind of it. Trended data we covered a little bit. So
Yeah, I do have a question that came up, Jim,
yeah,
and it's a nice segue to the end. So
okay.
thank you very much, Maria. Maria wants to know: is there a fee for a client to clean or fix their credit with you? It's a great
Yeah,
question.
yes, there is. We don't charge any advance fees. That's a big thing. And here, there's a lot of it. I'll leave this up there for a quick second, but we don't charge advance fees. We do everything by the book, legal, the right way. Our fee is a small fee. It's 189 in 14 days, 99 months a month. It's the only way you can legally charge. Our goal is to not keep them in a monthly program long. It's to get them back to you so you can sell them a house as quickly as possible. So, and in some instances, that's a month, 2 months. And certainly, if it's more complicated situation, it may be longer. It just depends. The whole idea is to get them to you as quick as possible.
Yeah, we appreciate that too, and Jim does a great job with getting them to us. There's a much larger national competitor that seems to want to keep people in those programs for years on end, um, and their approach is to address one trade line at a time. Where when we get the clients to Jim, they address everything
Everything.
at once. So
Right.
let's get as much off of this report as we possibly can. So
Yeah, and we always do a free consultation as well. So we can, and here the whole goal is, to be a partner with you, manage the people that you can't sell a house to now so that you can sell them not if, but when.
yeah, and Jim's done some great things in a matter of 30 to 60 days. So with our folks. So um, Ray, I'm going to get to your question and well, actually, what is the average time to clean credit from Ray?
Well, I mean, we've had thousands and thousands of clients, but I mean, I'd say the average is probably 3 to 4 months, but it just depends. I mean, certainly here, there's plenty of people that, are referred to us. They actually don't need credit repair. Sometimes they need simple advice, and everybody just doesn't need to enroll. It's all about a relationship of, getting them to the closing table as quick as possible. So, and certainly we've done that with you, Rich, and your team many, many times over and over. So, but if we're working on somebody, sometimes, the average I would say probably 3 or 4 months, and sometimes it certainly could
Cool.
be more. It just depends.
Yeah, and he's done some stuff quicker than that I'll touch on in a second. So the slide that you guys are seeing right now is Jim and I have actually, so our group, we have created the Kimball Team Financial Wellness Series, and our first program is going to begin Saturday, April 10th. This is a program designed for consumers. It's going to be a lot different than what we talked to you guys about today, because you guys are in the real estate world, you've got a little bit more familiarity with credit. We've designed a program where this is going to your borrowers, your homeowners, customers in your database. If your customers got kids that are starting out, they want to learn about credit, get them invited to this. How we're going to do it is this. You'll see that we just kind of put a logo of one of our real estate partners, but it doesn't have to be Real People Realty. This is designed to show you, if you're interested in doing some marketing into your own database or your CRM where your leads are at, we can create this piece co-branded with us and yourselves. And then you can go ahead and use this as a piece to connect with your existing clientele and then bring them to this recorded session that we're doing on Saturday. So we wanted to, it's Saturday, April 10th. It'll be from 9 to 10. It's all directed to the consumer. They'll be able to ask questions, but our goal is to help them in their path, whether it's to be a first time homeowner, to get their credit fixed so that they can, maybe qualify for that refi. So if you're interested in this, email me or Tony on my team. Will create this flyer and go ahead and bring some people to it. We're going to market our own database. It's not going to be specific to any realtor. Your people are going to come in. Jim and I are going to do a very similar program like this, but your clients are going to come in feeling like this is a program for them. So
And real
we're
quick,
excited. Go ahead, Jim.
yeah, real quick on that note, don't, I encourage it to make this an opportunity for everyone, not just, pinpointing people that have credit issues, because a lot of times people don't want to, sort of address that, I guess, or so. I mean, and honestly, credit education is good for everybody. I mean,
Yep.
regardless of what your credit score is, it's good, and they don't teach it anywhere else. So it's good information for everybody to know. So it's not necessarily it's going to be beneficial for people that have credit problems, but it's really going to be beneficial for everyone, really.
Yeah, no, that's perfect. So I got a couple of the questions that came in. So how far back do mortgages check on your credit? And ultimately, we look at the credit report. How far back do the credit report show us history, Jim?
Well, anything that's on there is considered. So it's not that the mortgage industry will look at certain, if it's on a credit report, it's part of the consideration of the scores and anyone that's looking at the report. But generally for adverse information, and there's a couple variations to this, is 7 years is typically how long something can stay on a credit report, unless interject, questioning or the CARES Act or things we were talking about with repair.
Yep.
Things will naturally purge after about 7 years, unless it's student loans. Those can be on there forever. So,
What
uh,
about bankruptcy? Still 7 years or 10?
no, well, it's different for a Chapter 13 and a 7. A Chapter 7 is 10 years from the date that you filed it. For a
Okay.
Chapter 13, it's 7 years from the date that you discharge it, not to exceed 10 years. Essentially, it ends up being 10 years in either.
10 years. Okay.
Yeah.
I've got another question. Actually, Tawana, I wanted to ask if this was a specific to Real People Realty. No, they guys, we picked that logo just because I couldn't stuff all 40 agents logos in here, but ultimately you guys, your stuff will be co-branded in here. No particular agency is going to be mentioned relative to the event that we do on Saturday. We're just going to be talking about credit. So let's see here. A lot of thank yous. Jim, you did a great job today, and we appreciate you, everything that you do for our clients. I will tell you guys, we have vendors for a lot of things, title companies, appraisals, you name it. And this is the only vendor relationship that I've had for 12 years. Since Jim's opened his doors, he's taken care of every one of our clients. We get no money, nor do I ever want any money from them, because what I want is I want a client to come back to me with great credit that we can put in a house. And Jim has done just that. So
we get you commission checks. That's what we do.
yeah, exactly. Those are the checks you guys all want: commission checks and referrals, because we took great care of you. So
And if
great
anybody
care.
has questions for me ever, obviously you can go through Rich. You can contact me. It's anything credit related. It's what we do.
Yeah, put the contact information back up there real quick, Jim, if you can
Oh,
fall back to that
yeah.
slide with your contact information too. And you guys can reach out to us, Tony, myself, we can get you guys that contact information. Again, this financial wellness series, we're going to keep doing that. We've got some future things that we'll do in May. I'm really excited about being able to give back to homeowners. It's something that's been in my heart and soul for a long time. And honestly, with the assistance of Tony, she's making a lot of things happen around here. So we appreciate her help too. Jim, I appreciate you.
Pleasure.
Ray wanted to know if it would be recorded, and he wanted to go back to it. If you guys want a recording of this, send us an email. We'll get you out a recording. So any final words, Jim?
I'll send you that so you guys can share the link about establishing credit too. And No, thanks for having me. I mean, it's, I know credit's not flashy, but it's really important for everybody to know, and it affects all of our businesses, and we're here to help you with that.
Yeah, Jim did a great job. Tony, thank you very much for putting this together, getting everybody's sandwiches to them. I'm gonna go eat mine. Happy Happy
Thank you.
Thanksgiving. Listen to me. Hello. Happy St. Patrick's Day. So guys, enjoy your beer. I'll have one next week when I can. Take
All
care.
right. Thank you. Bye-bye.
Bye guys.